Good afternoon. In this problem, we're going to be looking at the analysis of financial statements. Basically, we're going to be trying to figure out how one company, like Up Incorporated, compares to another company, like the Down Company. Might look at this as comparing Company A to Company B. Now, we're not going to do this type of analysis in this problem, but another thing we could do is try to decide, is Up doing better this year than last year? Or is Up doing better last year than, did they do better last year than they did this year? Similarly with Down, are they on the right track or the wrong track? Well, first thing we need to do is get some idea of how the companies are doing, the raw accounting data. So we prepared a balance sheet. Let's look at it. For Up Company, cash is $25,000, inventory is $75,000, total current assets and total assets then are both $100,000. Accounts payable, the only liability and the only current liability, is $30,000, equity is $70,000, and liabilities plus equity are $100,000. On the income statement for Up Company, we have sales of $500,000, cost of goods sold $100,000. Those net to a gross profit of $400,000. But then, as you remember from Accounting 211, we take operating expenses like salaries expense and insurance expense and subtract from gross profit to get to net income. One of the things I want you to notice here is cash and inventory together, totaling assets, is a column. Often, the accounts payable and equity would be a separate column next to it, and it would total to liabilities and equity. With regard to Down Company, we have something similar. This was deliberately designed to be a very similar balance sheet and income statement. In reality, companies are usually compared who aren't so similar. Here we have a balance sheet for Down with cash of $50,000, inventory of $100,000, and it makes assets $150,000. Then we have accounts payable $60,000 plus equity of $90,000 equals liabilities and equity of $150,000. And remember how those compare and are required to be the same number. Assets equals liabilities plus equity. Again, picture assets as one column and liabilities plus equity as another column. Then the income statement. Sales $600,000 minus cost of goods sold $140,000 gives us gross profit of $450,000. From here we subtract salaries, $250,000, and insurance of $125,000, and we come up to net income of $75,000. Well, armed with this data, we can do analysis. Horizontal analysis, one of the first things that your book talks about, is not typically something we do comparing one company to another. Horizontal analysis is best done comparing one year to another, or in other words, looking at the trends for a company over time. Are they doing better this year or worse? That gets its name because often in a financial presentation, assets of the current year and assets of the last year are shown side by side, which means showing this year's cash and last year's cash is a horizontal activity. We can, however, do good vertical analysis using the data we have. Vertical analysis is often something used to compare one company to another. So here we have two numbers from Up's income statement. We have gross profit divided by sales. Well, if we divide Up's gross profit by sales, we come up with something called the common size gross profit. We turned gross profits which wouldn't be comparable ups is 400,000, downs is 500,000. What does that mean? To comparable common size gross profit, because we're looking at what percentage gross profit up is versus down. So the gross profit for up was 400,000. The sales for up is 500,000. Gross profit divided by sales is 80%. For down, gross profit is 450,000. Sales is 600,000. We divide gross profit by sales. Our common size gross profit is 75%. Here, up is better than down because 80% is better than 75%. Let's consider a few very simple ratios. Now, ratios can take and consider a variety of data. Ratios can consider which company is more liquid. They can consider which company is more profitable. They consider which company is more likely to survive or which company is more solvent. And they might decide which company's stock is a better value. Well, in the interest of time here, just to go over financial analysis, but limit ourselves to just a small amount of ratio calculation, let's look at the current ratio and a very close cousin of it, the acid test ratio. These two ratios measure liquidity. Which company can pay its bills without having to reach into assets that aren't current, like equipment? Well, Up had a current assets of 100,000. Remember, that was its cash plus its inventory, divided by current liabilities. The way the ratio is computed then, current assets are 3.33 to 1, which means the company has more than 3 times the amount of current assets it needs to pay its current liabilities right now. Down, by comparison, has 150,000 of current assets divided by 60,000 of current liabilities. And in each case, remember, the only current liability we had for up or down is accounts payable. So here, down's current ratio is 2.5 to 1. Advantage again is to up at 3.33 to 1, which is better than 2.5 to 1. However, when inventory is involved, I prefer the acid test ratio, not the current ratio. The reason is this ratio, the current, the one you're looking at now, assumes that this company would sell inventory at cost to pay its bills. Companies don't want to do that. Typically, they would like to make a profit on the inventory. So the next ratio, the acid test, we're going to back out the inventory. Let's look at how we do that. There's a specific formula they use to get to that. Here we have 3 items which are considered quick assets: cash, short-term investments, and current receivables. Notice inventory is not in the list. So cash for up was 25,000, but for down it was 50,000. Neither company had investments or accounts receivable. Therefore, the total quick assets for up is 25,000. The total quick assets for down is 50,000. Divide this by each company's current liability. So the quick assets divided by the current liabilities are 25,000 divided by 30,000, or 0.8333 to 1 for up. And for down, 50,000 quick assets divided by 60,000 current liabilities is 0.833 to 1 also. There's no difference. Neither company's better than the other. But consider something here. This ratio shows us that neither company could use only its cash to pay its current liabilities right now. So, while the current ratio looked really good, acid test tells us these companies, if the current liabilities are due fast enough, might have to sell inventory at a lower price, sort of a clearance sale, to be able to pay for their current liabilities. And again, companies don't want to do that. So had one company appear better than the other, this would have had greater weight to me than the current ratio. Well, let's kind of summarize what should the company, Which company's a better deal? Which company should an investor buy stock in? Which company should a banker lend money to? And so on. So based on common size gross profit, up is better than down. 80% was better than 75%. Based on the current ratio, up was better than down. 3.33 was better than 2.5. And the acid test ratio, 0.8333, is the same either way, leads us to the conclusion that up is better. Remember, as I said before, acid test is better than current if a company has inventory. Well, hopefully this brief explanation of financial statement analysis has provided some very simple overview about how we use horizontal analysis, vertical analysis, and indeed ratio analysis. Let me know if you have any questions. Have a great day.